Up until the end of 2018, the prevailing standards for leases is IAS 17. Then the IASB mandatorily adopted IFRS 16, which presented major revisions on how companies present both old and new lease contracts in the financial statements. To appreciate this standard, you need to look back into the reasons why the changes are necessary. And believe me when I say that it takes about less than 10 minutes to do so. This is Accounting Zero to Hero. We are here to help you understand the fundamental accounting concepts through simplified technical discussions and practical applications of the accounting standards. All of this to help you go from zero to hero. Now let's go back to the video. The underlying reason for the shift to the new standard is transparency. To understand why, you should know first that under the old standard, most lease contracts fall under operating leases. You can refer to the video description for the official definition. Under this, most leases are treated as regular expenses with just the following journal entry. It's pretty simple, right? For example, if you rent a company car for 3 years and you are expected to pay $2,000 USD every year to the lessor, the annual entry would only be debits to rent expense and credits to cash or accounts payable every single year. In your balance sheet, IAS 17 does not recognize both the company car and the obligation of the company to pay rent over 3 years. This is because we are just treating the lease payments as rent expenses and the income statement as they are incurred every year. Just from here alone, you will realize that the old standard does not give a lot of transparency in the balance sheet because we are not disclosing the car that we are using in the business operations and also the company's obligations for future rent payments as per the lease contracts. Then come IFRS 16. The new standard improves transparency, most especially on the liability side of the balance sheet, by recognizing on day one that the company has the obligation to pay rent for 3 years. It does so by the process of discounting all the future rent payments into the present value at day one, using a discount rate which is normally the incremental borrowing rate. To simplify the discussion, we will not focus on the computations, but on the rationality of the entries that you will encounter under this standard. Just for reference, here we used a sample rate of 10% discounted for 3 years. You will find more information on the incremental borrowing rate in the description below. To recognize the total lease liability at day 1, we need to debit an intangible asset called the right of use asset. The right of use asset is IFRS 16's way of showing that we are using the car while not actually recognizing the car, but only our right to use it. That is why it is an intangible asset. In the subsequent year, all the lease payments reduce the lease liability instead of going into the rent expense. And since the lease liability is discounted, we recognize an implicit interest expense using the effective interest method during the duration of the lease contract, much like how we will recognize an effective interest on an interest-free loan under IFRS. Lastly, the right of use asset is depreciated over the useful life of the actual asset, and in this case the car, or the duration of the lease contract, whichever is shorter. So by the end of year 4, the balance of the right of use asset is 0 due to the amortization, and the balance of the lease liability is also 0 due to the rent payments and effective interest amortizations. So if you want to see the movements of the lease liability and the right of use asset in tabular format, here you go. You can pause the video if you want to take some time to see it. In summary, under IFRS 16, the balance sheet recognized the car, or more accurately, our right to use it, and the obligations for all future rent through the lease liability. In the income statement, we recognize interest expense through the effective interest method and the amortization of the right of use asset. You will notice that this looks very much different from IAS 17. If all these entries look familiar to you, then you are right. It is actually similar to what will happen if instead of renting a car, the company goes to a bank, borrows money payable in 3 years, buys a car in cash using the borrowed money, depreciates the car, and makes principal payments to the bank, incurring interest expense along the way. If you look at it that way, all the entries under IFRS 16 makes much more sense. The new standard improves transparency because showing only Rent expense in the income statement does not provide more details as to the future obligations of the company, what assets are actually being used, and what liabilities finance the operations of the business. This is it for now. I do hope that you learned something from the discussion. If you want to watch more accounting related videos, don't forget to subscribe and click the notification bell. See you!